This video is about a Bitcoin buying strategy that's designed to maximize the chances of buying the bottom and minimize the chances of buying the top. For me personally, I don't trade Bitcoin. I don't sell Bitcoin. I buy Bitcoin and I hodl. And historically, I just dollar cost average, meaning I buy the same amount at regular intervals regardless of the price, because that strategy allows you to take advantage of volatility and not spend all day looking at price charts. But I recently did an interview with James Check, basically the best on-chain analyst in the business. You can go watch that right here. And I asked him, of all the metrics that people look at, tons and tons of them are just noise. So which ones are true signal? He gave a very insightful answer, and he went on to talk about the strategy he uses. Now, he is a long-term Bitcoin hodler. He's not a seller, but he does look at a couple key metrics, not to try to time the exact top or the exact bottom, but to generally know when it's a good idea to be more aggressive about your dollar cost average because you're likely getting coins at good value, versus when to throttle down your dollar cost average or to turn it off completely because it's likely a time that euphoria is high, which means future returns are more compressed. Now you might say that's the antithesis of dollar cost average because you're not supposed to try to time the market. And if you have a decades-long time horizon for your Bitcoin and all you care about is stacking more sats, then I'm on board with that too. I get it. But I can also understand the value in wanting to minimize the emotional toll of buying tops or just temporarily accumulate some dry powder in fiat so you can deploy more heavily in deep value territory. So I'm going to play James's answer for you now. And then we're going to walk through the explanation a little more in depth. Real quick, if you're new here, you're watching the Sat Stacker Show, a Bitcoin show for people who think deeper about money. I'm your host. My name is John, aka the Sat Stacker. If you want to learn to stack smarter and grow your conviction in Bitcoin, you hit the subscribe button, and you can tap me sats via the Lightning Network using the QR code on the screen if you enjoyed the video.
So for me as a hodler, having bought the top many times in my life, I now prefer to look for when people are feeling kind of crabby and when they're starting to capitulate. Now I'm like, at a minimum, I know I'm not buying the top anymore. I just don't want to buy coins when it's high, and I want to stack sats when I know it's not the top. Now, what drives people to buy or sell? It's generally how they're feeling, and what metric helps describe how people feel? Things like MVRV, which stands for market value to realized value. It's basically showing you how in profit is the average guy. If it's very high, everyone's feeling really good. Twitter's very excited. People have got big green numbers in their portfolio. What are the smart money doing? They're going to sell and take profit because that's what they do. Then you get the people who buy that top. The market sells off, and there's another metric which is kind of the sister called SOPR, spent output profit ratio. So MVRV describes the unrealized profit or loss. How good are people feeling? SOPR looks at the same thing except only for coins that are being spent and moving. So what you see is that when people are feeling good, MVRV is high, unrealized profits are high. SOPR starts to tick up because people are taking those profit. That's starting to look like a top, the top, a local peak, a global peak. Then you get the people who bought in the euphoria thinking, oh yeah, let's go. We're going to 500K. And then it sells off down to 80 and SOPR goes negative. It means people who bought high are now selling low. And at the same time, MVRV goes to low levels, showing you that people aren't feeling so good. As a daily DCAer, when we've got short-term MVRV, people are not feeling good below 1, and short-term SOPR is below 1, so people aren't feeling good, and they're locking in losses. My daily DCA is switched on. And the moment we start moving higher, where everyone's feeling good and taking profit, I switch it off, because now I'm not buying the top, and I am buying a bottom, the bottom, every bottom, but I'm not buying every top. Just a great way to flip it around.
So here we are on charts.checkonchain.com. This is James's website. And what a nice guy. You can actually look at this stuff for free without being a subscriber. Whereas Glassnode or CryptoQuant or whatever, you'd have to sign up. Glassnode wanted like $100 a month or something ridiculous. Now, I'm going to be totally honest. Like some of you out there probably know a lot more than me about all these metrics and these charts because I'm new to this part of it. Because I've spent all my time studying the monetary components of Bitcoin, why Bitcoin is better money, harder money, why it has value, etc. Now he has the section here, which is short-term holder indicators. So he's already aggregated into one chart, the short-term holder indicator for us, which is going to have the MVRV and SOPR together in one chart. What a nice guy. Now I'm going to start by just going a little more in depth to explain the two metrics that James talked about. So MVRV, market value to realized value, market value, obviously current price times the circulating supply. And the realized value is what people actually paid for their coins on average. So because Bitcoin is a distributed public ledger, people who do on-chain analysis can literally see that and calculate it. It's basically a crowd sentiment gauge. It's basically showing you how in profit is the average guy. So in general, are people sitting on big unrealized gains, or are people underwater on average? When MVRV is above 1, people are in profit, the market feels good, confidence and greed is high. When MVRV is below 1, people are underwater, they feel bad, and there's fear, doubt, and more capitulation. If it's very high, people are feeling good. People got big green numbers in their portfolio. They're showing their screenshots. Everybody's celebrating. And what that generally leads to is that some of them are going to sell and take profit. And that's where the other metric that he talks about comes in, which is SOPR, which is not just about sentiment. SOPR is spent output profit ratio. Are people actually giving up and selling, or are they taking profit? Did these coins move at a profit or at a loss? SOPR above 1, coins are being sold in profit. SOPR below 1, coins are being sold at a loss. MVRV tells you more about sentiment and feelings. SOPR tells you more about actual behavior. And when we're looking at these metrics, we're not looking at long-term hodlers. James focuses on short term, which I believe is coins held under 155 days. So to see what's really affecting the day-to-day price the most, you actually have to filter out the diamond hands and zoom in on the people who are more likely to panic or get swept up into euphoria. Again, nobody is saying buy exactly here or sell exactly here, or this predicts the bottom or the top. It's probabilistic. It's just about tilting the meter on your DCA, not timing the market exactly. Because historically, when both MVRV and SOPR are negative, that's when the short-term holders are underwater and capitulating, and that's historically a good environment to lean in. When both are positive, that's historically a better environment to cool off and not FOMO in, like the tourists are. There's a much simpler way, obviously, to look at this, which is the tweet from Safety Moose. Basically said, you buy when no coiners are posting red screenshots and gloating, and you sell when Bitcoiners are posting all-time high screenshots and running victory laps. That's the simplest version, and the on-chain data just helps to back that up with real numbers. So this is the chart where James has aggregated the metrics he talked about. Now he's got more in-depth stuff on here that I don't think we need for these purposes. I'm going to toggle off the standard deviations, and I'm going to toggle off the futures funding rate. And we're left with, obviously, the Bitcoin price, the short-term holder cost basis, the MVRV metrics, and the SOPR metrics. Now, what he's done here is basically shown MVRV when it's negative, you can toggle it on or off. So only when it's below that horizontal line that is 1, and MVRV short-term holders when it's positive. So he separated them very cleanly. So you can see always when it's above 1, and you can toggle it on and off. Same thing with SOPR. So you can very easily show me only times when SOPR and MVRV are both negative, below 1, or the opposite. Show me times when SOPR and MVRV are both positive, above 1. Whoops, sorry. There it is. Now, the default zoom looks to be like a 6-year period. So the 6-year view is going to help you understand, are short-term holders right now broadly in profit or loss relative to history? So you can see what the different structural extremes look like, and you can see basically that the times where we're deeply in the negative in SOPR and MVRV are pretty rare. Then you can come up here and change it, obviously, to the last 6 months and the last 3 months. One, I think, way to think about it, maybe this isn't perfect, but one way to think about it could be use the long-term view to decide whether you're accumulating, use the medium-term view to decide how aggressively, use the short-term view to understand market sentiment, not exact timing. So here's one question I had, which is, let's look back at last fall when the price peaked at the all-time high of like 126,000. And let's say, would this strategy have helped you actually not buy the top too much? So we're going to try to grab like 3 months. We'll zoom in here, September to November. We're going to try to get 3 months. So the peak, I think, was October 5th or October 6th, right here. We know in hindsight that that's where it peaked, and we've come down almost 50% since then. So we're going to look and see, would the MVRV and SOPR both above 1 at that time, would that have been basically a signal to tell you to slow down your buying? So if we toggle off the times when they were negative, and we can just see green and orange when they were both above 1. Basically, we're not saying this would have called the exact top, but it would have told you it's a perfectly good time to slow down on your DCA. So both short-term holder MVRV and SOPR were above 1, which means short-term holders were sitting in unrealized profits, and they were selling into strength. And price, obviously, was above short-term holder cost basis. This basically would have told you this is not a high-edge DCA environment. That means you could reduce your DCA or reduce your frequency or pause altogether. Now let's contrast it with right now. I just reset it to the last 3 months. Obviously, price is under short-term holder cost basis. Short-term holder MVRV and SOPR are both below 1. Short-term holders are underwater and losses being realized. This is the opposite of what we saw at the all-time high. Obviously, I do also think that you can't help but notice that basically when you're looking at both those numbers below 1, you're also seeing the same exact timing of that is when price is below short-term holder cost basis. You could also just simplify this even further to increase DCA when price is below short-term holder cost basis and decrease it when it's above. That would probably get you, 70 to 80% of the benefit of looking at the even deeper metrics. The price being below short-term holder cost basis doesn't tell you whether people are actually starting to sell at a loss yet, but it seems to be a pretty good indicator. Like they definitely move together. And if you move back out to the default zoom, you can see that what we're in right now is a time that's comparable basically to only 2 or 3 other times in the last 6 years. This in March of 2020 is obviously COVID. This late 2021 was obviously what we know was that cycle peak, like 69K. And we know with hindsight being 2020 that we sort of went to a bear market after that. And then obviously the FTX crash was, I think, in November of 2022. Obviously, we know this was a good accumulation zone. So I'm not going to go through every single example and see if it's historically always been right, but seems to me to be directionally accurate in terms of at least gauging sentiment and gauging whether or not it's a good time to lean heavily into your DCA or back off of it. I hope you found this interesting. I just wanted to, for my own edification, do a deep dive to better understand the metrics that James was talking about, how to better understand it and see what's going on, and then potentially put this strategy into play. Obviously, right now, we know is a good time to be dollar cost averaging or buying more heavily because we know we just crashed. And I'm not going to say that 60K or whatever we hit was definitely the bottom, but we're definitely in a good accumulation zone as far as I'm concerned. And maybe 2026, I'll put this strategy into play and see how it plays out. Let me know in the comments if you've tried it or you think it's a good idea. But regardless, the most important thing, as always, is that you quit slacking and start stacking.